See, I think if you look at venture capital in India, you can't directly compare it to VC in the US or China because they're more mature ecosystems. More importantly, they've already succeeded in delivering outcomes. And I think when you deliver outcomes, you build a very different venture ecosystem than when you're still developing one. So I feel we've jumped ahead of the gun across the ecosystem, both in the startups that we back, in the unicorns that we sort of champion, and the VC firms that have backed them. What I mean by that is that we have not yet delivered outcomes, but we are actually incurring very high costs relative to what outcomes we've delivered. So in the US, if somebody's being paid X $1,000, X hundreds of thousands of dollars, usually it comes off the base of the fee structure of a fund, which allows that fund manager to be able to afford it based on prior track record and the strength of the fundraise that they've had. Whereas if you look at in the Indian context, we've raised 4, 5, 6 funds but not delivered too much back. So at one level, while we critique startups that they lose money, they've not yet become profitable, they're loss-making unicorns, this winter has shown that that's not sustainable, right? Everybody needs to fix that. However, no one's gone and questioned how much capital has actually been drawn down in terms of costs at venture capital firms without actually having delivered even 1x of the fund back, right? Which means most VC funds in this country are loss-making at one level, at least at a fund level, if not at an organization level. And we're still, wanting the same privileges that our peers get in other markets. So I think that dissonance will continue for some more time until we deliver outcomes. Why has this happened, more importantly? It's happened because India started exploding as an economy from the late 90s. So I remember when I came back from the US, left in 99, came back in 2006, my gross salary had jumped like 6-7x in that time frame. So what I left with was sub 5 lakhs. When I came back, I was closer to 30 lakhs. I'm just giving you a sense of actual numbers, right? On how much the economy had moved in terms of paying for certain quality of jobs. Now, venture capital in India is seen as in that upper echelon of jobs where, it's very privileged, very few jobs, very highly qualified people. Sadly, it's a cottage industry with very different skill sets and should not be compared to investment banking or even private equity for that matter. So just as my parallel is, just as in India we have justified the cost of building companies using other talent, entrepreneurial talent, tech talent, marketing talent, which is benchmarked to profitable IPO companies, right? So if you pull somebody from Unilever, he's not going to take a massive pay cut. So you've justified it by saying my startup is also worthy of that candidate, but you've still not shown how to make profits. A Unilever or a Bank of America or a state bank also makes a lot of profits. A fintech or a consumer brand may or may not be making those profits yet. So you've justified paying market salaries without actually ever knowing how to make money. And that's the need of the hour because you can't build a startup ecosystem from scratch. Somebody has to fund that. And while we have funded that, we have replicated that in the venture ecosystem as well. Meaning the funds behave as if they're private equity funds or investment bankers or merchant bankers who actually earn a lot of money, but of income generated. In India, we have actually not generated that income. It's fee income that we have borrowed from our investors in lieu of giving them great returns in cash, but those cash returns have not yet materialized. So as a result, we have a little bit of a lopsided incentive mechanism where we are benchmarked to very high fixed pays also, in my opinion, very long-term rewards for both the investors and for ourselves. But you have a eager set of people who say that, the startup world, is willing to take me on at a certain price. Why isn't the venture world willing to take me on at that price? So I think all put together, you have a misalignment of incentive which has to get right. It will happen when venture in India breaks out, delivers boatloads of cash back to its investors. And, we hit the holy grail of what great venture investing is, which some of the best American firms have done. So as per the theme of the podcast for this year, coincidentally, American venture firms have also compounded. They've built intergenerational firms. They've built, multiples of capital returned across multiple funds. That kind of compounding has yet not happened in India. So that's what we are all waiting for, and that is the big difference between India and the US. So in the holy grail of venture capital, if you go raise a new fund for, let's say, $100, you essentially draw down about 20 every year. And so the investor who gives you that 20 is actually giving it to you with a lot of happiness. You know why? Because one of your old funds is actually delivered 20 or 30 rupees to their bank account the same year. And that's the holy grail of venture, that you draw down equal or lesser money than you've actually returned to your investors. And I think that era actually exists in a better part of the US. Maybe mismatched a year or there because of a bull market or a bear market. But fundamentally, that's what they want us to become. And I think that's when a venture firm also looks like an IPO-able company or an IPO'd company in its portfolio, because it is in a true sense profitable on cash flows every year. And this, I think, large private equity franchises have achieved globally. They've also begun to achieve that in India. We haven't seen that yet in India. And so venture has another 5-7 years to truly break out and prove that we can be counted amongst the best globally. The venture business is an apprenticeship business, much like a sushi chef, right? So I want to be able to equate a venture journey to the equivalent of becoming one of the best sushi chefs in the world. What I mean by that is, when you apprentice, you don't use your intellect to basically think you've solved the problem on day one. You essentially learn each subset of the trade very carefully to be able to deliver that perfect sushi roll, even almost, blindfold. And what that means in that analogy is, you need to know how to boil the rice, what water content. So there's rice preparation, there's fish cutting, there's sauces, there is the assembly of all of these, and there's an art form. And sushi chefs take 5, 8, 10, 15 years to master the craft before they're even allowed to serve their customers. And so in venture, I don't think we'll get such patient learners in youngsters. But the reality is, either you have learned some of those skills in jobs outside of joining venture, which I would like to believe that my experience led me to. And even now, I think I'm still learning, 12 and a half years into the journey. But I also spent almost 12, 13 years outside of venture before I started Blume. So it feels like all those collective learnings have given me the toolkits to be able to be a good venture investor. So if someone's coming in afresh and you've not had enough experience or you've never worked in venture, then you're starting pretty much at ground zero, right? You don't even know what rice looks like to be able to boil the rice in the analogy. So let me cut over closer to someone who's in their early to mid 30s, which means they have some experience, some knowledge of the ecosystem. The ecosystem is so much more vibrant today compared to 12 years ago when we started. So you've learned from either a startup experience or friends in venture, friends in startups. So you have a little bit more of a base knowledge and you're trying to build on that. But then what does it take to actually become a great venture investor while sitting inside of the venture firm is non-trivial in my view. And that apprenticeship and that training comes by carefully observing, listening, picking up traits, and then honing them to your strengths and skill sets. So I would say, I would break it into 3 parts, right? And before you know that you've mastered the craft. The first part is you observe your own firm, right? Because that's your biggest training ground. You can't borrow from what you can't see. So you can't read somebody else's blog and say, oh wow, what a great blog. Yeah, it's fine, but you know how that investor decides on whether to invest or not, what their frameworks are, how they actually act after the investment is done. Because a lot of people might pick well, but their entrepreneurs might say that they're terrible board investors and terrible partners. So you don't want to pick on examples which you do not understand fully. So the examples that you would understand fully, for better or worse, whether you like your firm or not that you joined, is your foundation will come from your team's partners, right? So observe them, understand what traits work for them, what traits the end customer appreciates. So I don't think to be a great venture investor, you need to, in the first 5-7 years of your life, even wonder what LPs are looking for, right? Which are our investors. That's a different part of the job. And there you simply make returns and they will reward you amply. So your focus is going to be to understand the other customer, which is the entrepreneur. Why does an entrepreneur want to work with you? Why does an entrepreneur want to work with a firm like Blume? Why do they sense that you will be actually able to help them on that journey? And I think that's been our winning card when we've played, right? Which is our ability to show that we are a great partner to you on the journey. It's a perilous journey. And you should love to have us because of the reputation we've built and what we've actually done for other founders. That's how the reputation has gotten built. So this differs from person to person. So it's not, I would recommend not to blindly copy paste, right? Because your persona might not lend to how I treat a certain founder, or my communication style, or how I deliver bad news or good news, how I celebrate it with them. There might be somebody who's not who's a teetotaler and somebody who loves to go drink. And so personas are different when you engage with a startup. Then within that startup, if you have a core functional skill, like in my case, I think it's the equivalent of investment banking, capital markets, then I'm able to walk them through what and how to position themselves for a next fundraise, how to think through debt equity. And if you see, about a third of Blume's leadership and firm is probably oriented towards engaging with founders and giving them great advice on that and acting on it, getting them the money, right? And that's what founders want to see. So if that's a core skill that you can develop, as an example, you should do that. Suppose you came with a marketing consumer behavior mindset. Then what you would do is pick the sector that appeals to your sensibilities, which is, let's say, consumer brand or consumer internet or apps or social media, and then double down on these behavioral insights that you can actually give and lend to the founder, which they're not getting necessarily from any other quarter. So even if you give them 10 insights and they've thought through 6 or 8, the fact that they get that last 1 or 2 from you creates a eureka moment. They love you for it. And so I think the key is to recognize your strengths, see what each different partner and persona in your firm is delivering to founders, maximize their exposure in the first 2 to 3 years, and then double click on what can I do better, right? And like, for example, our friend Sajid says, writing is a superpower. And how does he help a founder through his writing? He even writes great pieces on them. He explains their business. He makes it more understandable. So even while he's doing what he's doing for the firm, he's actually helping out founders in a different way. Arpit's a product guy. He loves geeky stuff. Sanjay is a relationship guy. He basically opens up, networks. And Ashish is a, guts of operations and finance guy. So each one of us talk to the founder differently in our own unique way. And you have to recognize, do you fit with 1 or 2 of these personas better than all 5? If all 5, then you're like a genius in the venture world. You're a perfect all-rounder, very rare to find. And then you can go toe-to-toe with the founder on a couple of things, which is when they appreciate having a partner like you alongside them. And so that's what I think the craft is all about. The second is to observe others, because I'm not telling anyone inside of a particular firm to be unidimensional and only view the world from their lens, because there is nothing like perfection in this art. So Blume's art form might be different from Nexus or from Axel or Peak or Elevation. So essentially, you have to observe the other's art form too. So at Blume, for example, we've started trying to bring guests from the other firms to come and speak to our investment team, just so that everybody gets a sense that they're not being left out in learning what other personas look like. So that's one. That's a very compartmentalized one to our engagement. But what is the real, other meat of what you can see? If you're fortunate enough to land up as an observer in meetings or in group meetings, then you see other firms in action too. So what you applied with your own firm, I would encourage you to start thinking of applying those lenses on other firms, partners, and team members as well. Not necessarily your peers, because they're learning. You don't want to learn from someone who's half learned the trade. And then you over-index on the style again that you like and the performance. Eventually, no point mimicking somebody's persona if they really suck in terms of performance or how they're viewed by the eventual LP. So this is the spectrum of learning that's available to you. The last part, I think, is most important. Each firm has the ability to put up a framework on why they pick a company. And eventually, by the way, you and I get paid as a VC or an aspirational venture investor for making the great picks and guiding them through tough journeys to get to the end state. And sometimes luck, of course, plays a big part. You can't count on luck, but you can count on your input metrics, which is basically what are all the risk parameters that this founder and this team and this opportunity have, and what does the reward look like? For all this risk, does this look like this can truly become a market-shaping, multi-billion-dollar company, or is it just an incremental company and it still has risks? So you start dropping those and you start understanding through investment committee meetings, through the pipeline in the firm, why certain decisions are being made. And we have situations where people vehemently disagree with a decision that I've made, right? And there's nothing right or wrong, because again, you can't build consensus, but you can learn from how people are applying these frameworks to their own decisions. And the important part is not just that, it is how you imbibe those frameworks for yourself. If you're not in agreement with them, we've actually had a few people in the firm historically, I think, realize that early stage, seed stage venture is not for them. They just can't grasp the complexity of risk that is thrown and imagine how this can ever become a multi-$100 million company, leave alone a profitable unicorn. So they actually stepped back and stepped out perhaps from the firm. So I don't recommend that everybody attempts what we do. I think venture also has 3-4 grades of risk. So you have to assess which risk you're most comfortable with, because that is core DNA. I don't think it's about a skill set which you can just nurture along the way. You can nurture all the other aspects of what I said in the first few minutes of this answer. I don't think you can nurture core risk-taking DNA. And we both might be in the same company, but you might prefer entering at a later stage and I might prefer entering at the early stage. And I think knowing that for yourself is a great, it makes it for a great venture investor. And it makes for great sort of self-awareness in terms of what kind of risk you like, which kind of firm you should be to be able to underwrite that kind of risk. And it'll keep you happy, more than anything else. See, all of these are avenues to so-called make money, right? You can be in capital markets to make money. Why do you come to venture? Because you think you like those journeys for that risk you take. And so please calibrate yourself with your self-awareness for the risk you're willing to take, not for 4 years, not for 3 years, but for potentially 20, 25, 30 years.